This is the little you need to know to start investing in stocks. We're going to start today with stocks and the stock market. So last week we talked about investing. We got to know why we had to invest, the advantages of investing. We touched a bit on compounding interest and inflation. And this week we're going to go deeply into stocks. The whole idea of knowing these things is so that when you get to that point where you are hearing these things, you want to start investing, you have to have knowledge, right? You have to actually know what you're about to get into. Because if you don't know what you're about to start, if you have no idea about the investment you're going to make, the possibility of you making mistakes is higher. This is one of the reasons why we actually have to learn. So have a nice breaker. So I'll send the link now to the charts so that we can all feel. I'll also send it on the WhatsApp group though. Just feel as honest as possible. It's easy, it's fast, it's simple. Let's just fill the form. Here's a question. It's basically just trying to know what exactly everybody has about earning from stocks. So the question is, how can we earn from stocks? I think people actually earn from stocks. So I just wanted to pick, I made it just an answer. So just pick one answer you're probably sure and submit, and then just give this like 5 minutes and we would go to the backstory later on. Moving on. So learning objectives. What exactly are we going to learn for the next 40 minutes? We're going to learn about the markets, stock markets. We're going to learn about public and private markets, IPO, which is initial public offering, categorization of stocks, and how to earn with the stock market, which is the initial poll. So maybe we might go back to the poll just when we get into that part. And then funds, the different types of funds that we have associated with stock markets. So I know a lot of us, we've heard stock markets, the stock market, stocks, markets, and all. What exactly is this stock markets? Before I go into using big terms, I would also want to advise that if for any reason you're no longer following, like you feel like I'm going too fast or I've missed out on some terms or you're lost at any point, please just send a message and I would come back, because the whole point of this is not just for me to do all the talking, is that you guys follow up and at the end you actually have an idea, right, of what's going on in stocks generally. So, my screen, I'm going to share my screen. Okay, so the stock market, this is really a marketplace. It's like where people come in to buy and sell stocks. As the name implies, the reason why it's called a marketplace is because just like a marketplace, people are coming in, people are buying things, people are selling companies, almost at the speed of light. So there was this documentary I watched, if Carnegie, Rockefeller, and there was one of the companies that actually was
When the Built America, that's the name.
It was how the stock market used to work before. Is someone stand on the platform and they are bidding prices, right? So there are people just walking in and be like, oh, I want to own part of the trains, the train sector. So they are bidding prices for each company, and that was how it used to be done. But currently, we now have online stock, online markets where people just go there and they keep on bidding for prices generally. So this is the stock market. It's where we have exchanges of different companies traded publicly. People are seeing what other people are bidding for it. Investors can buy shares, stockbrokers can buy shares, traders can buy shares, and they can also sell online. Now there are two major companies which we have. We have two, New York Stock Exchange and NASDAQ. So they're both virtual places. They're traded online. New York Stock Exchange actually has a building, but NASDAQ is completely online, where people buy and sell stocks. So all they do is they go on the platform, put a price, bid for a price, and whoever is willing to buy purchases at that price. That's just how the marketplace works. So one of the reasons why it has become safer. So I was talking about a documentary I saw. So what they did was I can't remember which of the men that built America. I think it was one that had a train. Vanderbilt, yes. The son of Vanderbilt was going to buy a company, and then they sold him fake shares, something like that. That was then in those days. So one of the reasons why they do this regulation is so that people won't sell off fake things. People would not ginger everybody to buy, because they still have stock scams where someone will call you and be like, oh my God, I have the next big stock. And if you can buy it right now, the next 3 months, you're going to triple your income or quadruple your income. A lot of people will go ahead and make purchases for those stocks. And in the end, they will not lose their money. So it's one of the reasons why we have a body or regulatory body that actually controls stocks, the buying of stocks, so that we will not have insider trading. That's the SEC. So primary markets. The primary markets are the first companies that issue shares to the public. So for example, my company wants to come with, oh my God, I think I'm going to, for those that were not around last week, we talked about what the whole idea of the stock market, how companies use it to raise money. So for example, I have a company and I want to raise money. I come out first. Before I come into the stock exchange market, I would actually be listed. I will be vetted by different organizations. I can't just say I want to go public myself. Most of the time it's investment bankers or investment companies, investment banking companies that would validate the stock. Then they'll put it out and say, okay, your shares can be worth this, so you can now do this. They vet if my statements are correct, all of those things before they bring me out to the stock market, the public markets. So they're the ones that will actually say your stocks should be worth this, or your stocks are worth this, based on what you already have. So that's like the primary market. Primary market is literally the first offer that a company gets when it first comes to public. Usually is one of the best things if you can get a company at the first initial offer. So that's the first amount that the company originally is selling to everybody. After that, the stockbrokers usually are one of the people that now determine the price. As all the investors are the ones that now determine the price after it. So most trading occurs on the stock market or the stock exchange market. For a really long time, most Nigerian stocks were not on most of our brokerage apps that we have now. Well, but what people used to do is you go to the company themselves and you buy stocks from them. That's why I said most are not traded on the stock market. So I had a classmate in secondary school that she said her dad got First Bank shares. Even my dad got Diamond Bank shares, but I don't think he remembers where he kept the certificates. But that was then. But now a lot of persons, being that the world has over digitalized, right? So a lot of us are now online trading it there. So the secondary markets are where investors trade the stocks they already have to other people. So let me go back. I have a company, and then I decide to come out. I'm selling, I'm selling phones. So I decide to come out and say, with this phone company I created, boomi.com phone company, I decide to sell a share for 1,000 naira, and then I get people to buy. Assuming 20 persons buy into my shares. Now, out of those 20 persons, Mr. A decides that he wants to now sell that his one share for 1,000 naira to somebody else. At that point, he's become the secondary market. So him and every other person that is buying from him, they're no longer the primary markets. They're not the first persons to actually purchase my business, my share. I don't know if that makes sense. So the next is price determination. So like I mentioned earlier, the initial price is determined by corporations, institutions, not determined by the company itself. So when MTN, no, let's say Glow currently is not really on our stock market. Very soon, who knows? So let's assume Glow wants to come into the stock market and they want to validate it. They'll also compare it to companies in its sector like MTN, and they're going to compare it to MTN and Airtel. So how is Airtel doing? Why is Airtel this expensive? What was the initial price Airtel came out with? So they do those comparisons and say, okay, I think this Glow can actually go for this certain price, because if Airtel is doing like this, MTN is doing like this, then maybe let's just do it a bit lower so that people can actually buy into the company. Then the second price determination is the secondary market, which is persons that actually now buy direct from the primary shareholders. They now decide that, oh, I want to sell the shares, or I want to sell the company at this particular price. So in the end, they are the ones that now newly determine the prices of the stock. So initially, it's an investment company that determines it, but on second thoughts, on the second part, it's now the secondary market that determines it by how high people are buying it. So if Mr. A is bringing up the share and is saying, this share, I'm going to sell it for 1,100, and people start bidding for it, because that's how the market works. So people start bidding, oh, I will buy it 1.5. Well, Mr. A is like, oh, nice. And he sells it for 1.5. This is a share he bought at 1,000. So because of the demand, the price has become 1,000. But imagine if you wanted to sell that, nobody's buying it. So that's why we are going to take it for 900 now. Or you guys take it for 800. That's what determines the price, demand and supply. Categorizations of stocks. Stocks can be categorized by different things, whether it's the size, how it does, how it earns, the location, the investments, there are different things that people use to categorize stocks. And one of the reasons why we do these categorizations is for we, the investors, to have an idea of what we want, right? So you can now decide that, oh, I want the stock based on this particular categorization, or I want the stock based on this particular categorization, or I'm interested in this particular sector, or I want to invest in this sector, or tech is booming, so I want to invest in tech, or I want a stock that will pay me dividends. So it's one of the reasons why we are going to take a look at the categorizations of stocks. So we have a few categorizations. I'm just going to emphasize on these four and mention a few others. We have by ownership, which we talked about last week, the common stock and the preferred stock, right? For common stock, preferred stocks don't give us voting rights. So we also categorize stocks by earnings. We categorize them by, do they pay dividends? Do they not pay dividends? How do we earn from them actually? Then we talked about investment style. That is more like, so if I'm investing in this stock, why am I investing? Why do people invest in this particular kind of stocks? Is it because they have the potential of growing over time, or is it because they have value in themselves? The next is by capitalization. That is the market capital, how big the company is, how sizable the company is, whether it's large cap stock, mid cap, or small cap. So by ownership rights, we know that one of the general, when you ask people how do they generalize or classify stocks, they'll tell you mostly it's common and preferred. But I'm just going to talk about these other ones because to help you in your decision making when it comes to buying stock you want to buy. So common stocks, shareholders can vote. They'll send you emails and be like, oh, there's a vote, there's supposed to be a vote, or they need a vote on something. Go ahead and cast your vote. Dividends, you would receive dividends from the corporation. But not all common stock companies pay dividends, but if they declare that they pay dividends, you get dividends from the company. Why? Preferred stocks, they don't have voting rights, but when it comes to liquidation, they give their shareholders preference when it comes to liquidation. Investment type. So another way we classify stocks is by their investment type, valued in the market. For example, Tesla. We know Tesla is a very big company. It has great potentials, and Musk is definitely doing something great there. But currently, it's not as valued or as pricey as Google or Microsoft. We can say it's because those ones are everywhere, but we know that Tesla has the potential of being to make electric cars for every country. Like I said last week, it's considered a growth stock because it has the potential to grow. It still has room to spreading out its net. As long as it's still in the market, it has room to potential to actually do better. So when we classify them by investment type, we are thinking of it as per their earnings, right? So the price that it is at right now, is it relatable to the price it could be? So if we see an iPhone 17 currently and is going for, okay, let me not say 17, let's say 16, which is the one before 17. It was expensive, but now the price has gone down. But we know that still a lot of people can't afford 17, so they'll rather go for 16 than 17. The price is not yet at the worst way that people will never buy it, but it has the potential of still increasing because people can rather afford it than 17. So it's like this particular stock has the potential to earn more, right? It's doing very well currently, like in the economy, it's doing well, but the price to buy one particular share is not yet up to the price to actually, like that it will actually cost. So if, for example, when MTN joined the market, MTN joined in as low as 100 and something, if I'm not mistaken, right? And compared to when I saw found out that Airtel is, I know Airtel is an international company, but my bias. So when I saw what Airtel was actually making, I'm like, it means that MTN has potential to actually get to where Airtel is based on their both international companies, but it's not always a guarantee. Why value stocks, right? They fall under two categories. They fall under the growth stocks and the investment stocks because we think of their price. They have low price. We also think of the fact that they have potential to grow. They usually reinvest their profits back into the company. So they don't pay dividends because they are still trying to grow and they are trying to make it in life. They're not interested in paying you yet when they've not finished reaching the peak of their potential. So this is one of the ways we pick stocks. We pick them by what is their current value versus what could be their current value. That is value versus growth. So do they have potential of growing? Or should I pick the fact that this one has already grown, it already has value, it already has a lot to offer? For profit sharing, these are companies that either pay dividends or you have the possibility of receiving a high capital return.
In growth stocks, when we classify them under profit sharing, we're talking about those companies that are expected to grow very fast. Usually, they become overvalued quickly because people will invest a lot of money in them. They're usually innovative kind of companies. So those kind of companies that will bring up new innovations and then their prices will go up. But they actually do not give out dividends. They instead reinvest the dividend or their profits back into the company. So these growth stocks are kind of risky because they have good potentials. Everybody's betting on them. So just imagine when ChatGPT probably came into the market and everybody's feeling like this is the next big thing, right? Open AI, and then people are investing a lot of money in it. But then if another AI chatbot comes in and kick it off the market, it means that a lot of people will sell out of the open AI that was the one big thing. So that's how growth stocks are. So growth stocks usually grow very fast, their prices
Before we
increase
move
a
to
lot,
capitalization,
but they
there's
do
also
not
something we
give out
call blue
dividend.
chip
But
stocks.
usually
It's
their
very so
capital
chip stocks
returns are
are the
amazing.
luxurious stocks, the Fortune 500s, the ones that we know that they are making a whole lot of money. Those stocks are reliable. They have their name. They are strong. They are competitive. They can stand the weather and everything that comes. So those are blue chip stocks. They are the pricey ones. Apple, Microsoft. Our pricey ones. So let's go to market capitalization. This is dividing stocks by the market capitalization. What's market capitalization? That is the number of shares they have and the amount. So you want to know how much is your total capacity. If we say this particular share has 7,000, this computer company has 7,000 shares, right? We'll then do how much is one particular share times the 7,000 that is outside. It will not tell us the full bulk of what is in, of what the stock is. So they're usually large cap stocks are, they've broken their stocks in a million pieces. Not really a million, but they've broken their stocks into a lot of pieces. So it's a lot. They have a lot there. And then they are usually stable. They have a lot of shareholders. Their price is doing very well. So by the time you're multiplying, let's assume a company has 10,000 shares and each share is going for $1,000. When you do the maths, you know that this stock is stocking, as opposed to mid-cap companies, which are just, medium size, they're doing very well, they are growing, they have less, they're not as risky as small stocks because to a reasonable extent they've beat those limits over the years, and then they give us rewards, they have good potential, good everything, they're good, they are fine, they're standing on both legs. Then we have the small cap stocks, which are the ones that are new. They're just coming to the stock market. They just probably came public. People are just hearing of them. They don't have as much persons. A lot of persons don't know them. So these are the small cap stocks. They have higher risks because they're still, they're still shaky. They've not got to the ground. They're companies that might be young, seed funding, decide to go public to add up, or they probably got money or something. These are one of the ways that companies get into the stock exchange market, and then they are small, but they are growing, they have potential to grow. They can grow well when people feel like this is the future, and they can also bubble up based on different reasons. Companies go down based on different reasons. I dropped a link for a poll both on the group and on the chat. I don't know if we filled it, so I'm going to go back there before I move to how we end, just so that I can have a clear picture. So I can have a clear picture of what everybody. Oh, I hope everybody has been able to fill it successfully. I'll share the link again before I'll run the poll. If you're just joining, I'm going to bid you welcome and say that I'm sending a link to the group. This is just a little icebreaker we did at the beginning, just to figure out our mindset behind stocks generally, just figure out that. So quickly, just fill it up. Let's see how cool. Let's see what everybody thinks of what everybody's saying. This is fine. Is there anybody we're still waiting for to cast their poll so that we can move on? So the question is, how do you think people earn from stocks? And we had about 35.3% of persons saying all of the above. They think we can earn from everything. While the second runner would be when the stock price goes up and you sell it, 29.4% of persons think that that's how we earn from stocks. And then we have a fair number that says they don't know, and another that says trading, everyday trading. I like those people. Anyways, a lot of ways by which people actually earn from stocks. We're going to just talk about 3 out of the numerous ways people earn from stocks. And one of it is dividends. A lot of us are familiar with dividends. Dividends is the regular payments that a company gives out of its profits to shareholders. So they usually have a format, a periodic time that they pay, whether quarterly or annually, based on the company. So we know that a lot of persons like buying dividend-based stocks, but that's not just the only way we actually can earn from stocks. We also have we have a long list of ways, but I think for starting, this is for me, just the first 2 is fine. So when you buy a company stock, right, they pay the profit per the number of shares you own. So if you own 1,000 shares of Zenith Bank, and then they say, oh, they're going to give 3 naira of dividend per share every quarter, it means that they're going to multiply 3 naira by the number of shares you have. And if I have 1,000, or if we have 1,000, you're going to earn 3,000 naira. So imagine if you now have 10,000 shares, you're going to do 3 naira times 10,000, giving you 30,000 naira as a dividend payment. That sounds, it's 30,000. That's good though. But yeah, you get the picture. So that is how dividend is calculated. So if it's quarterly, they pay you quarterly. If it's annually, you get paid annually. Then the next is capital gains. So usually this is where value and growth stocks give us income. This is the profit that is made after you sold your stock at a higher price than you bought it. So this one is I would say dividends are more called passive income because you're earning without doing anything, without even having to go and sell. Because most dividend paying companies, right, they actually still grow. So it means that after they've paid you, you still have the possibility of selling it higher. So you get paid, like you literally earn from both capital gains and dividend in one. Why capital gain stocks? They don't pay dividends. Most of them are growth. Most of them are value stocks that they have potential to grow. So what they usually do is they grow, and when you sell, you make money out of it. That is how capital gain stocks work. So if I buy MTN when it came out, or if I bought MTN when it came out, sorry, at let's say 100 naira per share, and I bought 2 shares, making it that I used 200 naira to buy 2 shares. And after 5 months, MTN grew and became 500 naira per share. It means that I have also had an increase of 500 naira per share, which, and I have 2 shares, meaning that I've earned 1,000 naira as opposed to the 200 naira I used to buy. So I'll do 1,000 naira minus 200. My profit is 800 because I bought it at 200 and now it's worth 1,000 naira. It doesn't always work like this. So don't think it's, I already mentioned in the last class, disclaimer in the last class, this is not flip overnight. So the next, another way people make money from stock trading is by buying and selling of stocks. So they bid and offer. So they believe that they watch the stock chart and of a company, and they decide that, and they predict that this company is going to do like this company is going to do like that, and they bet for or against it. So they sell against or they buy, right? So they can buy the stock at a low price, predicting that it's going to go high. So betting for the market and making money out of it. So the other ways people actually make money from stocks sometimes is profit sharing, other times is let's say share bonuses, where some companies will tell you, oh, we'll give you a certain number of stock for, like if you have 10 stocks, we'll give you one. It rarely happens. I don't think it's not one of the most basic and stable way to earn money. So we're just going to focus on this. So the next is funds. I don't know if anybody has ever heard about funds before. So funds is just literally people coming together to do business, right? So let's assume we're a group of five friends. We all want to go into farming, different sectors of farming. One person wants to go into poultry, the person is going to livestock, the other person is going to fishery, just going around like that. And we decided that let's all contribute. So I will all bring one and use one particular farm. So the whole idea in the stock system is where different investors come together. They buy different, they bring in different companies and they invest in it together. So there are different, there are different types. I just highlighted this for, but there are different types, and each fund has a way that it's identical to itself. So depending on your objective or your aim from going to the funds. So for example, index funds. Index fund is almost like a general, sorry, index fund is almost like a general name for funds. It's basically the combination of mutual funds and ETFs, extended traded funds. So, but based on the fact that it's similar to this two, index funds is what most stock brokers use to judge the market. It's a combination of the top companies. It could be, for example, S&P 500 is the combination of all the 500 top companies in America. So index funds go by sector. So if they say if you want to get an index fund in the tech sector, it's going to combine all the companies, all the top companies together, right? They join it together. So you're not just investing in one company, you're investing in a company in a particular in these sectors. So they pick out these companies in different places just to give you some level of safety. So even if the health sector is going down, tech is going up, or tech is going down, agriculture is going up, your legs are like safe. So let's go to mutual funds. Mutual funds, as opposed to index funds are not managed by professionals. It's passively managed. It's not the one that someone is actually like trying to trade it, right? So index funds is a particular sector showing. So if you have, imagine if you get 100 companies in healthcare and we're watching how they're growing, it will give us, to a reasonable extent, we can make safe assumptions that the health sector is doing bad by the way the biggest 100 companies are doing. I don't know if you get how index funds explain the market. So a lot of people say that index funds is what they use to judge this current situation of the American market. It's not 100%, but to a reasonable extent, you can make a good judge out of it. So when you look at an index fund in a particular sector, it tells you how that sector is doing. Now, mutual funds, unlike index funds, are managed by people. So these are people that their jobs are to trade and invest in different things, whether stocks or other companies. They are ideal for people that I don't have time, but I want to actually start investing. These are people that mutual funds are. So mutual funds is like an amper basket. It comes with different things. It's not just one sector. You bring some things from the health sector, bring something from the tech, bring some things from agriculture, bring some things from energy, add everything together and then invest your money in it. One of the advantage of mutual funds is that most of these people, they go for different kinds. They don't just stick to ETFs. They don't just stick to dividend growing companies. They go to small companies that have potential to grow. They see companies that are coming into the market and they go ahead and add it to the basket. So they just bring a mix of different things to invest in, give you the possibility of actually having better profits. Now, they get paid a percentage of what you earn. Mutual funds are not very, very safe, but you're not really doing the money yourself, and nothing really is safe. Everything has potential of what if in it. So mutual funds are not strictly just the stock markets. They involve other assets. They can go into bonds or money markets. And one of the most popular mutual funds is Stanbic IBTC. They're the most popular mutual funds in Nigeria. And then we have ETFs, extended traded funds. These SM ones are similar to index funds, but they are strictly traded like stocks. So in as much as they are different companies coming together, they appear in the stock market like a stock. So everybody can buy. You can just go and decide what you want to buy. So the ETF will show you the list of companies under it, and you decide to buy it, right? And then their prices change just like stocks because it's like a cumulative of all the companies under them. So it shows you the price, and it's more stable because when people are trying to get ETFs, they will pick different companies. Like I mentioned, an index fund, S&P 500 or even Vanguard, one of the most popular ones. Those ones, S&P 500 goes for the top 500. Is it $500 billion companies or the top 500 companies in America. So that is what they invest in. So there was even a time that I remember there was a time, was it early this year, that Tesla went down and it was removed? So they do those kind of things. They even AT mobile company was removed from the top 500 a few years ago and was replaced with another company. So these are how ETFs work. Hedge funds. Hedge funds are the OBOs, the rich people. So it's usually a private investment company. It's for people that have a lot of money to make the market move. From the documentary I saw, the hedge funds were one of the it was a hedge fund that actually predicted the 2008 stock market crash. I think there was one hedge fund, and the investors wanted to go all crazy because he was betting against the economy of the US, and they were all very, very wealthy persons. They had a lot of money to bet against the markets. So most people invested in him because they believed that he was like, his maths was nowhere to be compared, right? Imagine betting against the economy for 3 years. That was what he did, and that was what crashed the housing market. He bet against the housing market in 2008 because he saw a gap in it. So hedge funds, they usually privately run companies. They need people that you have money that you want to invest, and you're not going to be tricking eye on how it goes. You give them autonomy, and they get paid a percentage of it, right? So they aim for high returns with high risks, and they try to switch things. And their liquidity, they can help in. I mean, they because it's a one-in-one thing, being that it's a hedge fund, it's easy for them to actually pay off if there's any crash of any kind, as opposed to mutual funds or ETFs that are traded like stocks. It's easier to just get liquidity for them. So this is the end of today's long and mouthful section. Tax for this week. I don't know how many persons here actually did the tax for last week, but even if you haven't done the tax for last week, please, it's not too late. I would send you to the group again. I encourage everyone to go ahead and do the tax for last week. So the tax for this week is to write down a list of companies. You're going to write down a list of companies that you would like to buy. So you can decide to pick 5. So have 1 or 2 ETFs, right? Pick from different sectors. Why advice for ETFs is because it's like safe buying. You buy from a mix of different companies. So look for 1 or 2 ETFs. Go for ETFs that are paying dividends. Don't just pick dividend paying stock. Also go for 1 or 2 stocks that they don't really pay dividends, but they are good. Go ahead and buy those stocks, right? So just decide. The tax for this week is decide 5 companies you would like to own their stock. That's it. Last week we decided the amount we want to save. We started saving so that we can buy our stock this year. Now the next tax is decide what stock you want to buy. So it could be, go and check out for stocks that are paying you dividends, check out for ETFs and that are popular. Just pick 5. Pick something in your sector, something you're familiar with. So if you're in real estate, go for real estate firms. If you're in food and beverages, go for those kind of firms. If you're in academics, go for edutechs, go for those kind of the firms that back up those things. If you're in the medical related sector, any medical related sector, you go for medical based companies, go for medical companies. If you're in tech, go for tech. If you're fascinated, even if it's not where you're working, if it's where you're fascinated, your interest is, go for those stocks based on your interest. Fashion, my dear, go ahead. All you do is think of companies. Go and check out companies that are available on the stock market and go ahead and make your purchase. Literally, there's no point of go to what you want. So just look, what you have to do is look for it. You can list out what are the top 5 companies, what are in fashion that are on the stock exchange. Look at these companies, which of them which of them resonates with you most? Go ahead and purchase them, right? Not all companies are public. Some companies don't need public money. They are fine where they are, so they might not be on the stock exchange market. So go for public companies, companies that are listed, and go ahead. So we're going to next week. We're going to talk about the different brokerage companies in Nigeria. We're going to create our account. I personally use Bamboo. I have both Chaka and Trove, but I personally use Bamboo. The friend recommended it for me, like then over 5 years ago, and I was using them before I heard of any other one. So it's Bamboo. I'm going to, for those of you that don't have, it's Bamboo. Me, I will introduce to you because it's Bamboo. I understand the interface well. But I have Trove and Chaka. I've not used AfriVest. I've not used RiceVest, but we'll definitely talk about the different brokerage companies in Nigeria. We're going to also create and fund our accounts. So even if it's 5,000 naira you've saved up by next week, it's fine. You put your first 5,000 naira. If 1,000 naira you want to put, it's fine. You put your first 1,000 naira. You take baby steps until we make giant steps. And then we're also going to talk about the common investment mistakes. With these few points of mine, I hope I'll be able to convince you and not to confuse you that there's something to be gotten from the stock market. I hope I've been able to explain what the stock market is. I hope I've been able to explain different kind of fundings, how we look for stocks. So we talked about investment. What is your investment target? What kind of thing do you want to achieve by investing in stock markets? Talk about ownership rights. Are you more interested in liquidation? Are you more interested in dividend payments? Are you more interested in vote rights? You decide. If you also look at earning, I know most people are more interested in earnings. They're more interested in the companies that will pay them. You decide the stocks you buy based on these things. Is it based on market capitalization? I want the company that will never have issue to fall. I don't want to hear that it decided to go in, at that. So these are the things we're going to that I want you to consider when you're picking your 5 stocks. So thank you so much for joining. I hope you had a great class. Oh, I have not sent the link for those that did not get an email. Please just give me a bit. Let me share the link with everyone so that you guys, because I'm only going to send this recording via mail, and the slides to be sent via mail. Please, if you started your financial goal, give me. Please, guys, let's make our plan. Let's make our financial plan. It's not just about having it in your head. Write it down. If you can paste it in your room, paste it in your room. You can paste. If you can save it on your phone, add it to your calendar. Let it remind you. Go ahead. Let me just run it quickly. So let's go back. We're going to use a SMART technique. SMART, S for specific. So the target or the goal should be very specific at what you want to achieve. You should specify the exact thing you want to achieve. So for example, if my goal is to save 20,000 naira and put it in stocks, then so if my goal is to save 20,000 naira and put it in stocks before the end of this year, I would write it that I, Bomejumo, will save 20,000 naira by 18th of December to invest in the stock markets. Being very specific at, and M is for measurable. So how would I know when I've actually achieved this goal? Something that will help us know that it's measurable, or that can also help us measure it. So I can say if I save 2,000 naira every week for the next 10 weeks, I would be able to come up with 20,000 naira. So by the end of my 10 weeks, when I see 20,000 naira, it means that I have actually saved this amount of money. The next is a achievable. You look at your life. If I lose 500 naira today, will I cry? No. So if I lose 500 every day, will I cry? You do two and two together. Instead of buying this coke, let me just put the money into my savings for stock. That's for me, that's one of the best ways to actually save. Just exchange it to things that you'd have spent money on. R is for relevance. How relevant is this particular goal setting to your life? Do you really want to start investing this year, or you're just here for show? The next is time bound. Put a deadline. It's not just about I want to save or I want to start investing, but actually setting out a time to go ahead and do it. So thank you all so much for staying this long. Oh my God, I stayed there for 20 minutes extra. I'm so sorry. Please forgive me. Promise, next class, we will not stay this long. But please, I would like us to go ahead and do our findings on the stocks we would like to start investing in. We're going to create a watch list. That is like a list of stocks you want to buy. So because you created a watch list, you can just be looking at it. So I can also send my Bamboo link for anybody that wants to register and go ahead without it. So thanks so much for your time. Have a lovely day and good night, everyone.